Focus. You have missed so many classes. So currency futures in India. So what happens is basically that what we have done is options. Options, futures are linear products. Options are not linear. Why I say linear, non-linear? Because futures you have unlimited potential of losing and unlimited potential of gaining. In options, you may have some unlimited and some limited. So it's not like linearly. So a person who enters into future contract, he can either lose or he can gain. There is no midway. He can't just simply walk to the contract. So when we are into currency futures in India, there are some currencies which are traded: USD INR, Euro INR, Pound INR, and Japanese INR. So these are the currencies which are traded on the Bombay Stock Exchange or National Stock Exchange. Okay, so these are almost like 80%, 90% of all the currencies of the world. Total number of transactions happening. So these are all covered. Okay, and anytime there will be 12 contracts which will be open in the stock exchange. 12 contracts will be open all the time. Now we are in the month of October, so there will be October till September next year. There will be 12 contracts. So depending upon which month you are going to receive or which month you are going to pay the money, you have to only look for that particular month. Other months you can just ignore. Suppose I have to make a payment in the month of February 2024, so I'll go into that contract. Okay, I'll take position in that contract. For other months contract will be of no use to me. Fine. So earlier there were 12 monthly contracts, but now the stock exchange has added weekly contracts also. Okay, so there are weekly contracts also, uh, particularly in USD INR. Okay, fine. So fine. All the last trading day, all the weekly expiry contracts, all weekly expiry contracts will expire on the Friday of the expiring week. So weekly contracts will expire only on the Friday, every Friday. Okay. All contracts other than weekly will expire 2 days prior to the last business day of the expiry month. Okay. Suppose we are in the month of October, so 2 days prior will be 29th of October, 33. What is the date today? 28th. So tomorrow this expiry day will be there for the currency market. Okay, and it will end up at 12:30. Fine. So if it is a monthly contract, it will expire 2 days prior to the, and tomorrow happens to be Sunday, so it has already tomorrow is Sunday. Okay, so maybe the expiry has already happened. That means on Friday. Okay, fine. Is that okay? So what is a contract lot size? There is a lot size here. $1,000 lot size, €1,000 lot size, £1,000 lot size, and 1 lakh yen for Japanese yen. So you take position in multiples of $1,000. Okay, it's a standardized, not customized like in case of forward contract. It is standardized because you can't take position in any number of dollars you want. It has to be in multiples of $1,000 if it's dollar is your currency. If it's the Japanese yen, then it will be in multiple of 1 lakh Japanese yen. You can't take anything like you have 1,75,000 yen exposure. Either take 2 lakh, either you're underhedged or overhedged. Is that okay? Now, when you enter into a contract, you have to pay a margin. Two kinds of margin: span margin and exposure margin. Okay. There's a software which is there, span software is there, so which calculates the margin. Now, the margin is basically based on what is the maximum 1 day loss you can incur, or what can be 1 day gain or loss. That stock exchange software captures 1 day में कितना ज़्यादा loss हो सकता है किसी में. So that margin they will collect upfront. Okay, fine. And an exposure margin. So there are two kinds of margins they are going to collect, because 1 day may not be just sufficient. Suppose the stock falls from say 100 to 100 to 80, so there can be a 20% kind of a gain or loss to a person who taken a bet. So the maximum loss is captured by the span, 1 day loss. Okay, and exposure margin is just little bit over and above. Okay, and then the matter doesn't end here. The stock exchange is going to do mark to market settlement. Every day settlement is going to happen. Once you are given like the margins to the stock exchange is going to square up the position every day. Okay? If you are bought a dollar at 83, it's gone to 84, you're sitting on a 1 rupee profit, 1 rupee will come to your account. But the next very day, if the dollar goes back to 83.50, then 50 paisa loss will be taken off from your bank account. Okay? So every day till the expiry. So that on the last day, there is not a huge kind of money which you have to pay or you will get. Fine. Because somebody is, going to lose huge sum of money at the end because there was no mark-to-market settlement. Then there will be a kind of a counterparty risk involved in the trade. So to protect the trade, the government of India introduced this after 1982, after the Harshad Mehta scam. Then it was thought that it is better that we should have this mechanism that people should, if the person becomes bankrupt, he doesn't have money. So at the most he can, on the last day he can lose that money, but there is still a margin, span margin and exposure margin still with the stock exchange. So there is no chance. This is a 100% foolproof kind of a game which the stock exchange is playing, so that the person who is making the money, he will always chance of getting the money, 100% chance. Okay, so it doesn't mean that the transaction will just fall flat and somebody loses because the other person has become bankrupt. He may not get the money. So that has been ruled out because of all this mark-to-market settlement and because of the span and exposure transaction. Usually the span is about 2% in the case of the USD versus INR or the currencies here. Talk about the currency market here. And exposure is around 0.5%. So upfront 2.5% will be taken from you. These margins can little bit change here and there. Okay. But this is the time when the slide was made that this was the stock exchange regulation. Now how does the settlement happens? The settlement happens on the RBI reference rate on the day of the final settlement. As we have seen in options, RBI is going to publish the rate, and that rate becomes the rate on which the accounts of the two parties will be settled. The closing price of the spot, which is the rate at which the transaction will be settled, which is given by the RBI. Now, we did last time this example. Okay, just I'll do one example, and then we can just move on to the where I left, in some part I have not covered. Suppose there is an importer. He has to make a payment of $1 lakh, and today think that it is 1st of June, and he has to make the payment on 28th of July, and today the dollar happens to be at 82.41. Okay. Now on 1st June, when he goes to the market, okay, he looks at the quotation, he finds that dollar is trading at at 82.6050, the July contract, because now he has to look only at the July contract. He doesn't have to look any other contract. So we can just go and see the same thing in the stock exchange also. So here so I'll go to the futures now. Okay, futures. So I have to say buy. I am if I am a importer, I'll buy. I'm bullish on the dollar. Dollar is going to go up. I'm going to make money. But in my real transaction, I'm going to lose. But in the stock transaction, I'm going to gain, and that will get nullified. So I'm hedged. Okay, I'll discuss that when you go to the slide. So here I just go to futures. Then I have to select a contract. So then I will get all the weekly and the monthly contracts. It goes right up to September 2024. So if my I happen to be, say, in the month of February, I have to make the payment, I'll look at this rate only, 83.61. All other rates are irrelevant for me. And this is the last traded price, okay? So if I have to say a buy, so I'll buy, okay? Then, so it will give me this window. I want to buy dollars. When? USD INR on 27th of February futures. So the contract has already appeared in my window. So this is the contract specification, contract name, and now trade is buy. It is green. How many? One lot. So I can change the lots. I can make it 100. Okay, fine. The margin will come at the bottom. This much margin I have to pay. Okay, and then I have two options. Just remember here. One is this, where the rate is automatically coming, which is the last traded price, 83.610, or the market. I can press anything. If I press 83.6150, then my trade will happen only at 83.6150. If suppose that the price goes beyond, suppose the price has gone up, my trade will not, be entertained. Because if the dollar goes to 84, the moment I put my order, so he says, sorry, we can't buy at 83.61 because the next best, somebody has put a bid or offer is at 84. So my order will not get executed. So if I put a market one, so then the limit price will go off. So that means I can limit my price or I can put a market price. So always when you are placing an order for buying stocks or buying for currency, there will be two options given to you. One will be the limit price. You can limit the price, or you can say market price. If you put a limit price, then whatever you have bought, it will be at that price or even less than that. Fine. Suppose I'm buying Reliance. Reliance is trading at 2200. I put a limit price of 2200. If the Reliance goes to 2400, my order will not get executed. But if it goes down to 2100, then the stock exchange will immediately buy this thing. I'll be getting at 2000. So it protects me for a loss at buying at a little costlier price. But when I put the market price, whatever price which is there in the market, the stock exchange is going to it will accept that order and will match against the best offer which is available. So I told you that last time. There is always better to look at this window, bid and offer. Okay. So this is a very important window. Please, Zoben, this is very important. छोड़ दो उसको, ये करते रहोगे आप. This is the most important thing in your life to understand. Always don't forget to go and see the bid and offers before punching your order. This is the must, the first rule. Okay, just press. So what it will tell you? It will tell you the top 5 buy orders and top 5 sell orders out of all the orders which have been placed in the stock exchange, which are hanging in the stock exchange, which have not been executed. Okay, which are just people have entered them in the market and they have not been matched with a corresponding buy or sell orders. Okay, so if you see, their total orders are about 9,300, 9,500 buy in, 9,520 sell orders, but the top 5 are given. So somebody has placed to buy 100 lots. What is the price? Bid price 83 point. So this guy wants to buy at what price? 83.60. Okay. Now the second is somebody wants to buy at a cheaper price. So he will be coming at the second priority. So the first priority will be given who has put the order at a higher price, because his chances of getting execution are much higher than the person who wants to buy at a cheaper price. Only if somebody selling, his guy will, there's another one who's, when get matches, then only the order will get executed. So they will be placed in the order of high to low. So somebody wants to buy 33, he wants to buy the price at 83.56. He thinks the price of the dollar will go down. So why should I buy at 83.60? So he has placed the limit order at 83.56. His order will get executed only if there is someone willing to sell to him at 83.56. But then there are corresponding sell orders which are lying unexecuted. Somebody wants to sell at 83.61. Because this order cannot be matched, so this is also lying in hang. So somebody wants to sell at 83.61, somebody wants to buy at 83.60, they are not matching. Unless the person sees this order and say, okay, I'm going to revise the price to 83.61, then the order will get matched. Isn't it? Suppose when I am on the screen, I am looking to buy 100, but I know there is one person who is ready to sell at 83.61. So for one contract, I will lower the price. Okay, I will jack up the price to 83.61 and then my order will get matched. Is that okay? Is it clear? So before placing the order, you must look at this. Okay, so last time I was telling you, because the market is so deep for the forex as well as the stock, even if you place the market order, you're not going to lose a hell. You should always go for a limit order to protect yourself. And some people don't have the idea, so they always go and put a market order. Okay, so maybe about 10 years back, I didn't have an idea about it. So I bought some bonds at 100 rupees, common bonds. and the price of the bond went up to 120 because the interest rates have come down and the bond prices were climbing. So I was sitting on 20% profit on my bond. So I had invested 10 lakhs. I was sitting on 2 lakh rupees gain on that day. So I said, okay, let me encash my money. So like a foolish guy, without knowing what I'm doing, I sold my all the bonds at a market price. And there was no other bid and offers available at the time in the system. Somebody was just knowing that there are people like me having no knowledge of the market, they will be placing like orders like this. So he immediately saw somebody is willing to sell his bonds of 100 rupees, which was last sold by someone at 120. So that price was shown as the market price, but thereafter there were no further transaction happening. So he put a price of 90 rupees. Since I put a 100 rupees, I put a market order, so my order got matched with 90. Instead of making a 20,000 gain, I made a 10,000 loss on that date. It is called the impact cost. This loss is classified in books. If you read some books, it's the impact cost. If you read, now you will understand, but without having knowledge, you will never able to understand what that guy in the book is trying to say. Okay, either he doesn't know, or he has just put the text which is in the stock exchange market, that what is the impact cost. Unless you suffer it, you will not come to know what it is. Okay, is that clear? So now, so this is basically the window through which you can go for placing the orders. Okay, so fine. So here I am an importer. Okay, I am an importer. So what I am going to do, I am going to buy futures. Fine, I am bullish or bearish on dollar. What position I have? Bullish or bearish? Bullish. I am bullish on dollar. I think the price will go up, and I am going to make money while I take a long position in futures. If I would have been an exporter, I would have taken a short position. I am taking a long position because I will make money only if the dollar goes up in the futures market. Okay, so that is what I am betting. But if it goes down, I will make a loss. But since I have an underlying import transaction, I will be hedged. Okay, I will not be making a loss or gain in a complete transaction. But if I am a speculator, I will make a loss or a gain. Okay, depending on where the dollar heads. I have to pay a margin of 2.75. We have seen just 2.5%. At that time it was 2.75%. So I paid that. Okay. Now, what will happen? The case where the dollar goes up, I make money. The dollar goes to 84.10 paisa as given by RBI on the expiry day, then I'll be sitting on a gain. 84 minus the price at which I have bought my futures. Okay. So I made up 1,50,000 rupees profit. So now since the expiry has happened, whatever margin I had given, I'll be getting back. And but now the person who is an importer, he has to make a payment on his real transaction. The dollar is sitting at 84.10. So he has to make 84,10,000, but he gets a gain of 1,50,000 from the stock market. So there is a loss in the real market, gain in the stock market. So net, I am hedged at 82.60, which is the price at which I have taken my buy position. Okay. So here, whatever my actual position is, I have to take an opposite position. I am short in dollars. I am an importer. I don't have dollars. I'll take a long position in the stock market. Or I am bullish in dollars. I'm going to buy dollars because my bullishness says the dollar is going to go up. Though I may going to lose the money in my real transaction, but I'm going to gain in the stock market, and that will offset and hedge me. So whatever happens, my outflow will be only at 82.60. So this was a case where I was gaining. But what happens if I am losing? Suppose the dollar goes to 81.60, so I lose 1 lakh rupees. Okay, so margin will be given back to me, but I have to pay 1 lakh to the guy on the other side of the stock exchange. But I will be paying less now in my import transaction because the rate has gone. But I will not pocket that gain. Since I have lost 1 lakh rupees. So my net cost to me will be 82. So here I am totally hedged. Neither I gain nor I lose whatever happens to the dollar. In case of option, I make a gain when I exercise my call option or exercise my put option, but I can walk out of the contract if the dollar is going in my favor. So there, the chances of making money and chances of making, getting the potential gain from the spot market exist. But here, it's a linear product. Either I lose or gain in the future transaction, but net, I am held. Okay. Okay. Suppose there is a quiz question will be coming that suppose the price of some commodity, certain thing. Fine. So okay, we'll come to that question then and explain. Okay. So now I'm just going to run through. Speculation wala. This is very important. If you are a speculator, what happens? Through the futures transaction. Now he is a speculator. Okay. The first case is bullish on dollar. You can be bullish or bearish on dollar. You can either take a long position or take a short position in dollar. Suppose you take a long position in dollar, you are bullish. You don't have any underlying transaction. Now you take a bet on $1 lakh. Okay. And today is 2nd June and you're taking a bet in July contract. Now the rate of the dollar is 82.60 for the expiry of July. So you take a long position in the currency futures. Okay, you are bullish, you're taking a long position, you pay a margin. Now what happens? Now what happens is that the contract is going to end on 20th of July. Okay, since you have bought dollars, you on or before you can close your transaction. On or before 20th of July. Even you want to exit the transaction, you can do it earlier. Even if you have an hedging position, you can do that. But in case of a speculator, he would be just looking at the price of the dollar on a particular day and take a call on that day. Suppose on 25th of June, few days before the expiry, okay, he finds the dollar has gone to 82.90. Okay, he's sitting on a gain. He's sitting on a gain because he bought the dollar at what? 82.60. So he's making us 30 paisa gain, isn't it? So he thinks that thereafter the dollar is going to slide back. On the expiry, it may not be lick. The dollar is going to go back to 82.50 or whatever. He's going to lose money. So let me close my position and make 30 paisa gain itself today. He decides to gain. So he squares up his position to book profit. This is called squaring up the position. The whole process is called squaring up the position. So what he has to do to square up the position? I have bought it. No, I have bought it with someone. I don't know who that guy is because I bought it from the stock exchange using my laptop and I can't see the seller. So I have to now take an opposite position. Okay. Now I have to sell and somebody has to buy. Now it may happen that in both the transaction, I am a common guy. I am buying and I am selling. But the person who bought me in earlier and the person to whom I sold may be different. Okay. So since I am now selling, so squaring up means taking opposite position the same contract. Same contract month में आपको opposite position. ये नहीं कि आपने अगस्त में ली, सितंबर में ली, आपने जुलाई में खरीदा तो जुलाई में बेचना पड़ेगा तभी square up होगा. Okay. Now he sells 100 lots at 82.90. No margin required because the second leg of the position. Now it may happen with someone else, but the moment I enter into this transaction, as far as any gain or loss taking place after that is not my baby. Because if I have gained 30 paisa now, that gain will remain intact. Because the other side leg may either put me in gain or loss and this position may give me gain or loss, that will not belong to me because that will get cancelled out. Isn't it? If I have taken a long position, any further gain will not going to come to my pocket because I had just taken the opposite position in my second leg. So all the gains and losses will get cancelled out. So I am basically sitting on a cash profit of 30 paisa. So I'll get 30,000 rupees. Okay. Margins will get released. Is that okay? आपने दो पोजीशन ली थी, एक बाई की एक सेल की, दोनों डिफरेंट लोगों के साथ थी, नो प्रॉब्लम. One position will give you money, other position is you will lose money beyond 82.90, so they will get cancelled out and ultimately you will be pocketing only 30 paisa. Okay, so this is all is there in our this thing. Okay, so just to cover those things in 5 minutes, I'll cover. Okay. So contract specs. Tick size is 25 paisa. So dollar versus rupee moves in 25 paisa tick. So tick size is 0.0025. So currency, will move in this order. It can't move to 83.26. It has to be moving in 0.025. So if it is 83.25, the next will be 83.50. Okay, 4 decimal places. Is that okay? So minimum tick size is this. Have you got it? What I want to say? Because the currency will, it can't move in 1 paisa. 1 paisa बढ़ गई, 2 paisa बढ़ गई, ऐसे नहीं है. It will move into 0.025 paisa. That's the movement of the currency. The trading hours 9 to 5 p.m. Currency markets are open from 9 to 5. Unlike stock exchange, which closes at 3:30, the currency markets will remain up to 5. Okay. Now there are 12 monthly contracts and some weekly trading cycle. Okay. The last trading day, we know that it is 12:30, 2 days prior to this thing of the month. The final settlement, last working day, excluding Saturdays of the expiry month. So it happens to be Saturday, then it will happen 1 day prior. Okay. Daily settlement happens apart from the margin and span margins you are paid. This is to protect the whole trade. Now calculated on the basis of the last half an hour weighted average price across exchanges. Now whatever is the price, because the last half price can fluctuate a lot, so the exchange what will do, they will take the half an hour weighted average price as the closing price. Okay, fine. For settling the daily settlement. For a monthly settlement, it will happen the RBI closing price. The daily settlement, because the last half an hour, the price can go up and down, up and down. A lot of people are, taking positions only in the half an hour. So, just to bring sanity, they will say half an hour, आखिरी जो होगा उसका average लेके price दें. The moment the market closes, Nifty closes, Sensex closes, after 1-2 minutes, the price, they put the new price, which is the last half an hour. This is. If the Nifty closes at say 19,000 today, 19,100, 3:30, but after some time it will come to 19,080 because that was the last and half an hour closing price, or it may be 110. If the market has gone very high, it closed at 19,100, but the closing will be below 100 because that was only the last few seconds close. Okay, so they will make a half an hour closing. Okay, final settlement will happen with the RBI reference rate. Okay, then contract size is like this. $1,000, which I explained. Okay. Currency futures in India are cash settled and not physically settled. Both options and futures are cash settled and not delivery settled or physically settled. You will not get a delivery of dollar, or you don't have to give your delivery of dollar or any other currency. Settlement daily and final settlement. If you don't close your currency futures contracts before expiry, the RBI reference rate will be considered as a closing price. So either you can close your transaction before the expiry, squaring up position, as we did in the case of speculation. If you don't do anything, automatically your transaction will get closed at the RBI reference rate. Either make gain or loss, depending on what RBI has announced. So final settlement, RBI reference rate, which is published by RBI. Daily mark-to-market settlement, which I have told you. Okay, just read the couple of slides only. So there is a very important word called mark-to-market. Have you heard this before? Beyond the future and options. So all the banks, particularly in India, when they at every closing they mark-to-market all the assets. Okay, they are, as per RBI, they have to most of the assets like investment assets, they have to show them at mark-to-market. Fine. Or even the company's balance sheets are prepared on the mark-to-market basis, particularly if you have a foreign currency transaction exposures. Okay, so market is mark-to-market means you look at the current price and either understate your assets or overstate assets depending on the dollar price or whatever is the price. Okay. Okay, आगे.
The exchange with the help of brokers and clearing house will collect this in PMR.
Okay.
From the loss bearing party and would pay the same to the gain.
So if you are making a gain, you will get it. If you are making a loss, you have to pay that loss on a daily basis. Is that okay? So that is called mark-to-market settlement. Final settlement, I told you. Okay. So this is the last slide.
On the expiry
Okay, now when the last day comes, then it is only the 1 day gain or loss which needs to be settled. So the last price of the last working day and the RBI reference rate, that will be either your gain or loss which will coming in your pocket. So that is what he wants to say. Okay, last.
Final settlement loss or profit amount is debited or credited to the relevant bank account on T plus 2 days.
So within T plus 2 days, you will get your account money, or you have to pay your money. Okay, and it will be the only 1 day settlement which will be happening on the expiry, because all other settlements have already happened till the last day. Okay, fine.